Hey everyone, welcome back to Corporate Decoder, the place where we take complex financial documents and make them as clear as a freshly wiped whiteboard. And today we're diving into Horizon Bancorp's latest filing, and let's just say they've been busy making deals and refinancing some debt. So what's the big news from Horizon Bancorp? Well, they've announced they've issued and sold $100 million worth of new notes, which is a pretty significant chunk of change. This filing is basically them telling the world about this big financial move. The date of this report is August 29th, 2025, marking the day this key event happened. Horizon Bancorp Inc. is the company we're looking at, and it's based out of Indiana. They are incorporated in Indiana, a state known for more than just cornfields, apparently. Their common stock trades under the ticker HBNC on the NASDAQ stock market LLC. This is what people buy and sell when they want to own a piece of Horizon Bancorp. The main event here is about a new agreement they entered into called a subordinated note purchase agreement. Think of it as them selling a loan to investors, but with a specific structure. They sold these notes, which are basically promises to pay back borrowed money for $100 million. These aren't just any notes, they're called 7-2-0-0. We call them $7 million. These aren't just any notes, they're called 7 to all. Then it can change based on market rates, and they plan to pay it all back by September 2035. That's a mouthful, but it tells us a few things. They're paying a fixed interest rate of 7% for a while, then it can change based on market rates, and they plan to pay it all back by September 2035. That's a mouthful, but it tells us a few things. They're paying a fixed interest rate of 7% for a while, then it can change based on market rates. And they plan to pay it all back by September 2035. They sold these notes at their face value, meaning they got the full $100 million up front, no discount. Now, why are they raising all this money? Well, a big reason is to pay off some older debt. They're using a portion of the new money to redeem, or basically pay back, about $56.5 million of their 5.625% notes that were due in 2030. This is a smart move. They're replacing slightly older, perhaps less flexible debt with this new longer term debt. It might also suggest they're getting better terms now than they did with the older notes, especially with the interest rate difference. Let's break down those interest payments. For the first part until September 2030, they'll pay 7% interest twice a year in March and September. This is a fixed rate, meaning it won't change for a good chunk of time. After September 2030, the interest rate will switch to a floating rate. This means it will change based on a benchmark rate, expected to be something called 3-month term SOFR, plus an extra 3.60% or 360 basis points. This can be good if interest rates go down, but bad if they go up, as their interest payments would increase. So interestingly, these notes were sold in a private placement. This means they weren't offered to everyone on the street, but to a select group of investors, likely institutions, doing so under specific exemptions from the usual public offering rules of the Securities Act. To make sure these investors have a clear path to potentially sell these notes later, Horizon Bancorp also signed a registration rights agreement. This means the company has agreed to take steps to register these notes, making it easier for the purchasers to trade them. If Horizon Bancorp messes up and doesn't meet its obligations here, they might have to pay extra interest. Now, a really important point about these notes, they are subordinated. What does that mean? It means if Horizon Bancorp ever got into serious financial trouble, like bankruptcy, the people who hold these specific notes would get paid back only after other senior debt holders. They're also unsecured, meaning there's no specific asset tied to them as collateral. This makes them riskier for investors, which is usually why investors demand a higher interest rate. They're also not guaranteed by any subsidiaries, so it's purely the parent company's promise. Bar night and used to rate, they're also not guaranteed by any subsidiaries, so it's purely the parent company's promise. And here's a key detail from a banking perspective. These notes are intended to count as Tier 2 capital for regulatory reasons. For banks, capital is like a buffer to absorb losses. Tier 2 capital is a less strict form of capital compared to Tier 1, but it's still important for meeting banking regulations. So this issuance helps Horizon Bancorp maintain its capital requirements. This section just confirms that the new notes create a direct financial obligation for the company. It's essentially reinforcing the information from item 1.01. Horizon Bancorp also issued a press release about completing this offering. This section is basically them saying they've told the public the good news. We're told that Exhibit 99.1 is the press release But importantly, the filing states that the information in this section and Exhibit 99.1 isn't considered officially filed for legal purposes, which is common for these types of disclosures to get information out quickly without immediate regulatory liability for every word. Like most public companies, they've included a cautionary note regarding forward-looking statements. This is a standard legal disclaimer. They're saying that any statements in the report about future events, opportunities, or plans are just their current expectations, and actual results could be very different due to various risks and uncertainties. It's their way of saying don't sue us if things don't go exactly as we hope or predict. Finally, we get to the exhibits. This is where all the actual legal documents related to the note issuance are attached. We see the indenture dated August 29, 2025, which is the main contract detailing the terms of the notes between Horizon Bancorp and the trustee Wilmington Trust. Then there's the form of the actual 7.0% fixed to floating rate subordinated note itself, which outlines the specifics of what these notes look like, and the form of the subordinated note purchase agreement, which is the deal document with the buyers, plus the form of the registration rights agreement, which, as we discussed, is for registering the notes for resale. But of course, the press release we mentioned earlier. There's also a cover page interactive data file, which is part of the modern XBRL tagging system that makes financial data machine readable. And the report is signed off by John R. Stewart, CFA, who is the Executive Vice President and Chief Financial Officer of Horizon Bancorp, certifying that the information is true to the best of his knowledge. Now, looking at this filing, Horizon Bancorp is clearly focused on managing its balance sheet and improving its capital structure. By issuing new longer-term debt and using some of the proceeds to pay off older, potentially more expensive or restrictive debt, they're essentially refinancing and strengthening their financial foundation. The fact that they're calling these Tier 2 capital highlights their strategy as a regulated financial institution. They need to maintain certain capital buffers to operate safely and soundly. This move helps them do that, likely at a more favourable rate than their older debt for the long term. The interest rate structure, starting at a fixed 7% and then floating, is fairly standard for these types of subordinated debt issuances. It offers a degree of predictability for the company in the short to medium term, while the floating component allows for adjustments as market conditions change. The primary risk here for Horizon Bancorp is if interest rates soar after 2030, their interest expense will jump up. For investors, the subordinated and unsecured nature of these notes means they are taking on more risk than holders of senior debt, and they are compensated with that 7% initial rate, which isn't too shabby in the current environment though. Always subject to credit risk of the issuer, and from a strategic perspective, this issuance signals a proactive approach to capital management. It's not just about raising money, it's about optimizing their funding costs and regulatory standing. Companies don't issue debt lightly, especially subordinated debt, so this implies they've done their homework and see this as a net positive. For their financial health and long-term growth prospects, they are also aiming to improve their capital adequacy ratios, which is crucial for a bank holding company. Overall, Horizon Bancorp appears to be making sound financial decisions to strengthen its capital base and manage its debt efficiently. The move to replace older debt with newer, potentially better structured debt while bolstering their regulatory capital is a positive sign of strategic financial management. They are navigating the complex world of finance by making calculated moves to ensure their stability and compliance. Alright, that's our breakdown of Horizon Bancorp's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description below for more community insights and discussions. Thanks for watching. See you next time.